Wall Street has just issued a massively expensive warning to every retail investor out there. If your portfolio holds semiconductor giants, big cap software, or even if you're just dollar cost averaging into the NASDAQ, what happened this week could directly determine the balance of your account next year. Just look at the violent volatility we've seen. Broadcom and Oracle, two absolute cornerstones of American tech, just released revenue data that beat expectations. The numbers on the books are growing. The result? The stocks were brutally sold off, both crashing over 10%. That is an incredibly rare signal in a bull market. For the past 2 years, the game was simple. If a CEO said AI on an earnings call, if they said, we are buying GPUs like crazy, or we are building data centers, the stock would take off like a rocket. Back then, the market rewarded dreams and expansion. But now, the script has flipped. Wall Street is screaming that classic Jerry Maguire line at every tech CEO, show me the money. Today, we need to figure out if this sudden capital expenditure panic, this fear of capital expenditure, is just a temporary pullback or the prelude to a crash in 2026. This isn't just a story about two companies. This is about where you need to move your money for the next 12 months. First, let's understand the core of this market panic. It can be summarized in 3 letters: ROI, return on investment. Let's zero in on the eye of the storm. Broadcom. Many people are still looking at earnings reports with linear thinking. Revenue is up, EPS hit the target, why is it crashing? In the current macro environment, that kind of thinking is lethal. Broadcom's drop reveals a fear of the second-order effect hidden beneath the AI boom. Broadcom is the ultimate shovel seller. Their biggest customers are the hyperscalers: Microsoft, Google, Meta. These giants are engaged in the most expensive arms race in human history, dropping tens of billions annually on chips and networking gear. The sell-off in Broadcom is essentially the market pricing in an expectation of inventory digestion. Think of it like running a restaurant. You see your supplier, Broadcom, stocking up like crazy, but the number of diners, the AI end users, hasn't doubled. Fund managers on Wall Street are running a brutal simulation. What if Microsoft and Google suddenly realize that the billions they burned on data centers aren't generating enough Copilot subscriptions? What if the incremental ad revenue from AI doesn't cover the electricity bill and depreciation? They will immediately cut orders. This is the famous bullwhip effect. In a world with a 4.75% benchmark interest rate, no one can tolerate sitting on piles of expensive, non-productive inventory. Broadcom's guidance was good, but it wasn't flawless. The market is starting to suspect, did we already pull forward 3 years of demand for GPUs and switches into 2024? Once a hyperscaler says, we need to pause and digest this inventory, stocks like Broadcom and even NVIDIA face the risk of bloody multiple compression. That is, investors paying less for every dollar of earnings. That is why holding Broadcom feels scary right now. You aren't investing in a chip company anymore. You are betting on the capital discipline of their downstream customers. Next, let's look at Oracle. If Broadcom is about demand fear, Oracle's crash reveals something deeper: business model degradation. This is a classic financial trap. Oracle was viewed as a high-margin SaaS, software as a service company. We all know the beauty of software: zero marginal cost. Copy the code, sell it, pure profit. The market loves this and gives it a 30x or 50x PE ratio. But to fight for the AI market, Oracle is mutating. What are they doing? They are buying land, securing power grids, building structures, and buying servers. If you look at their balance sheet, capital expenditure is running wild. Oracle is devolving from an asset-light software company into an asset-heavy utility company. For professional hedge fund analysts, this is a massive red flag. It's like a professor selling intellectual property suddenly deciding to open a steel mill. Your revenue might go up, but your ROIC, return on invested capital, is being massively diluted. We are entering the trench warfare of capital intensity. In this war, making money isn't as elegant as typing code. Every dollar earned has to cover expensive hardware depreciation, massive energy bills, and huge interest payments. Remember, the cost of money is around 5% now, not 0. When a company's business model gets heavy, the market ruthlessly kills the valuation. The market says, since you've become a landlord renting out servers, I can't give you a tech premium anymore. I'm giving you utility valuation, maybe 15x earnings. That is the mathematical logic behind Oracle's 10% drop. It's not that they aren't making money, it's that the money is harder to earn. Their earnings quality has dropped. All of this brings to mind a disturbing echo from history, the Cisco moment of 2000. I don't want to be a doomsday prophet, but the current market structure bears a striking resemblance to March 2000. Back then, Cisco was the most valuable company in the world. The logic was identical to buying Broadcom or Nvidia today. The internet is the future, Cisco is the plumbing. Whoever wins, they need Cisco. Was that logic wrong? No. The internet was the future. If you traveled from 2000 to today, you'd see We Live Online. But if you bought Cisco at the peak in 2000, you were a bag holder who had to wait 15 years just to break even. Why? Because the speed of infrastructure construction far outpaced the speed at which applications could make money. We laid the fiber, installed the routers, and readied the broadband. But Google and Amazon were in their infancy, and Facebook wasn't even born. Without killer apps to generate cash flow, all that bandwidth sat idle, leading to severe capacity glut. Today, we face the same risk. The eve of AI capacity glut. The giants are gambling. Microsoft, Meta, Google, they are all betting that if they stack enough compute, a super app will magically appear and generate hundreds of billions in profit to cover these costs. But reality check. Current AI applications, whether ChatGPT or various copilots, are amazing, but their monetization is lagging far behind the cash burn rate. When infrastructure is overbuilt and application revenue doesn't catch up, a valuation reset is inevitable. The Broadcom and Oracle crashes are the market casting a vote of no confidence in this chain of logic. The market is pivoting from rewarding expansion to punishing expenditure. So, as rational, serious investors facing high rates and capital expenditure panic, how do we protect our pension funds and IRAs? How do we find alpha in this volatility? This isn't about selling everything and running away that's emotional. We need a cold, hard audit of our portfolios. Here is the playbook. Strategy 1. Avoid the heavy asset trap disguised as growth. Open your brokerage app right now. Check every tech stock you own. If a company has a PE over 30 and their guidance says they need to spend billions on GPUs or data centers, but they don't have verified software subscription revenue to cover it, sell it, or trim it, with a risk-free rate of 4.5%, free cash flow is king. Do not bet on companies that have dreams but no cash flow. Let the venture capitalists take that risk. That's their job. As secondary market investors, right now, we need certainty. Strategy 2, rotation. Find the winners in the application layer. History tells us that when infrastructure gets crowded and expensive, profit margins migrate. Smart money is starting to flow from hard tech to soft tech. What is soft tech? It's the companies at the top of the AI food chain, the application layer. In a gold rush, instead of buying the shovel factory that is facing rising costs and fierce competition, invest in the guy who rented the shovel and actually found the gold. Look for companies that don't need to spend billions building data centers, but instead rent compute to optimize their products and raise prices. Think Salesforce, think Adobe, or fintech companies with proprietary data. The logic is beautiful. Let Oracle and Broadcom fight the trench warfare of capital. Let them eat the hardware depreciation. The software companies can sit back, use AI to boost efficiency, and charge higher subscription fees. This is called arbitrage. This is why in the decade after Cisco crashed, the real winners were Amazon and Google, not the infrastructure providers. Strategy 3. The defensive counterattack utilities and energy. If you are worried about a tech bubble but don't want to miss the long-term AI trend, look at the power sector. We need to accept a physical fact. AI is a disguised energy crisis. AI is a tireless electricity monster. Training a large model consumes enough power for a small town. Inference running the model consumes even more. In the US and Europe, grid capacity is becoming as precious as oil was 20 years ago. The bottleneck for data centers isn't chips anymore, it's power. This means companies with stable power generation, nuclear technology, or critical grid infrastructure hold the keys to AI's future. Add some high dividend, high quality utilities to your portfolio. This gives you a defensive dividend, usually 3 to 4%, plus the cushion of underlying assets, while exposing you to the inevitable demand from AI compute. This is selling water to the gold diggers, but it's water they cannot survive without. Whether OpenAI wins, Google wins, or Elon Musk wins, they all have to pay the electric bill. In conclusion, the drop in Broadcom and Oracle isn't the end of the world, and I don't believe the AI industry is ending. The technological wave is unstoppable, but this week's volatility is a deafening wake-up call. For the rest of 2025 and into 2026, the theme of the US market is no longer close your eyes and buy AI. The era of spray and pray is over. The next phase is about stock picking and verification. The market is entering a mature, brutal phase. We have to be like picky auditors, scrutinizing every balance sheet. Don't be fooled by CEOs talking about dreams without discussing costs. Watch their free cash flow. Watch their ROIC. In this crazy market, the real risk isn't asset prices falling. It's not understanding why they are falling. If you understand the capital expenditure panic and business model degradation we discussed today, you are more awake than 90% of the market. This is a moment where wealth shuffles hands. Some will stick to old logic and become bag holders. Others will read the new rules and seize the opportunity of the next decade. I hope you are the latter. If this deep dive helped you cut through the fog, hit like and subscribe. No fluff here, just hard financial logic stripped of the noise. I'm your analyst. Let's ensure we not only survive this capital battlefield, but go home with the spoils. I'll see you in the next video.